Welcome to the Marks Group Minute. I'm Matt Arnold, here today with my colleague Brett Angel. Brett, you recently wrote an article for the Star Tribune really focusing on the next recession. And I know if clients read just the headline, they might be a little bit nervous, but your point was the exact opposite, I believe.
Right, so we're writing on the topic of a recession, which has been in the news a lot lately. If you're turning on the TV, you see people talking about it. If you go online, there's a lot of polls as to when exactly we can expect the next recession to hit the U.S. economy. And the point in writing the column was really just to understand, to tell people, first of all, it's when this happens, not if it's going to. Going back to World War II, there's been 11 total recessions. You're talking about a period of roughly 70 years, so every 5 or 6 years or so this happens. It's a very common occurrence. And then we think it's just time better spent for people and investors to understand not specifically when this is going to occur, but how it's going to affect their investment portfolio. And then they can prepare either emotionally or making actual changes to maybe what they want to do.
Talk a little bit about the history of recessions and what that has meant for investor portfolios in the past.
Yeah, so like I mentioned, going back to World War II, which is kind of this modern period of stock market investing where we have more of the regulations in place. That's really the period we looked at. So there's been 11 recessions since then. Now, the most recent is also the most memorable, and that's the Great Recession that happened basically a decade ago. So part of that's the recency bias, but also how painful that was. So the S&P 500 went down 37% in the 18 months during which the GDP for the US contracted. It went down more than 50% peak to trough, and obviously if you were invested in equities for that period of time, you remember that. But historically speaking, that was the outlier. So in these 10 other recessions going back to World War II, on average they've lasted 9 months. And yeah, there's been double-digit corrections in the performance of the stock market, but really nothing that approached what we saw in the Great Recession 10 years ago. So that's more indicative of, I think, what to expect from the next recession. And again, it's something that we should prepare for and be mindful of, but not necessarily something that you need to fear.
Good, thanks. And I think that the important thing for investors too is too often they try to time it. They hear the word recession, they see it in the news, and they say, now it's time to get more conservative. But as we've discussed, there's no dinner bell that rings that says the recession starts now, and there's no bell that rings that says it's now over. As you described, that in the past, the market can go up significantly in periods of the recession, before the recession, and after the recession. And even economists go back after the recession's over and say, well, actually our recession started too much prior than when we thought. So this timing thing is really impossible to do.
Yeah, you're exactly right. So first of all, you have to have 2 consecutive quarters of contraction in GDP. So the recession starts 6 months before you actually even know that you're in a recession. Okay, so by definition, that's kind of a difficult thing to time. The other thing that we noticed when we were doing some research for the column was that on average, the S&P 500 goes up 15% in the 12 months following a recession, so obviously very good performance after, and that in the 12 months prior to a recession, again looking at these 10 other than the Great Recession going back to World War II, that the S&P was actually positive. I think 7 out of 10 times in the 12 months prior to that. So you don't have to get out or even reduce your equity exposure to perform well. And then the other thing too that's happened is we're in this really historically high period of volatility right now. So in December, for example, there were 19 trading days. The Dow Jones Industrial Average, moved at least 400 points plus or minus in 10 of those 19 days. So when that happens, people get more pessimistic. It leads to, a lot of negativity in market sentiment, and the market just behaves more irrationally. So now you're in a period when the market moves faster, meaning it's a more dangerous time to time the market, and you have moves that are a little less rational. So, we would just caution people generally for making any sort of major allocation changes in a period like this.
Thanks for insights. Thank you for watching. Like always, if you have questions on this topic or anything else, please reach out.